code. So tonight, what we are going to be doing basically is looking at those key things that need to be present, that need to be there if you are going to have a winning strategy. So what are the components of a winning strategy? So let me share my screen and we can get started right away. All right. So I don't want us to waste time. So I'll be going straight to the points. Like I mentioned, these basics. So I won't be going too deep into certain points and others as for the fostering program. So the first thing you want to consider on the path towards developing a winning strategy. I might even mention here at this point that virtually all the strategies, as those who have gone through the fostering program know, virtually all the strategies that I treat or that I use, I virtually developed all of them myself. In fact, most of the strategies on SimplyPips, we largely develop them. There are some things we can borrow from several other people and others, but the strategy as a whole are often things that we build ourselves. And I was on a Zoom with those in the expert advisor development class yesterday, and one of them was asking me that, do you even trade anything manually? And I just laughed because we've gone to the point of now automating most of these things. Now, one of the things I also try to debunk this night is also the whole myth around using indicators, not using indicators. You rarely find me trading without indicators. That's just my own personal preference. And I feel that what happens is many times we don't understand how indicators come into our trading, what indicators are supposed to be doing, and all that, and we just say, oh, a lag, or it doesn't work, or that. Which is not necessarily true. So if you understand what you are doing when it comes to developing your strategy, you'll be able to know if I'm going to use an indicator, what type of indicator do I want to use? What am I using the indicator for? Does the characteristics of this indicator actually fit what I want to do? And you can actually even build a strategy around an indicator. If you understand what the indicator is supposed to do, you can build a strategy around naked charts. So yesterday we were looking at working with candles when it comes to creating expert advisors, that's trading robots and all that. So we are looking at working with candles. And one of the things we looked at was how to identify your trend by simply using two candles. All right, taking a higher time frame and then looking at two candles to determine should I be buying or selling. And you can do that with moving averages. You can do that with so many things. So it's not. I want you just open your mind this evening. Forget. Don't be too restrictive. It must be naked charts, it must be indicator, it must be this, it must be that. Just open your mind, learn tonight. So the first thing you need to consider when you are developing any strategy is what type of strategy am I looking to build. So there are four general group of strategies. For me, there are really only two. You are either trend following, it's either a trend following strategy or it is a counter trend strategy. Basically, at the roots. So at the roots of all the strategies that we have, whether it's in stocks, whether it was developed by Benjamin Graham or anybody, almost every strategy basically has at its roots two types of strategies. One, you are either seeking to follow the trend or you are looking to go contrary to the trend for whatever reason that you might have discovered or developed yourself. Now, but spreading it a bit further, we have trend following, we have mean reversion, we have breakouts, and then we have counter trend. I'll quickly run through each one of them before going. Tonight, we are basically going to be dealing on trend following. I'll talk a bit on mean reversion before getting into that, but we are going to largely deal with trend following because that is what we advise or encourage newbies and in fact most all traders to follow. You can trade the other ones on the side, but most of your strategies should seek to follow what is going on in the market. Don't trade against the market. All right, so first one, trend following. Trend following, I think most of us are familiar with that. The market has been buying, we are looking to buy with the market. All right, so we are looking for opportunities to buy. So the market has been an uptrend, we are looking for an opportunity to ride that uptrend higher. Now, when we talk about mean reversion basically talks about a kind of trading strategy where you are basically saying we have a mean. That's why it's called mean reversion. So there's an average. So let's say if we put a moving average on our chart, let's quickly do that. Then would, let me take all this off. Let's use only the 200 moving average. All right, so we're just going to use the 200 moving average. And let's zoom in a little bit. All right. Now, the whole concept of mean reversion is that you have a mean, which is basically an average. All right. So price, as price moves up and down, up and down, up and down, it creates an average. There's an average. All right. By the time you sum up, of course, we know how we create averages. You sum up the number of candles. So when we say, for instance, 24 hours, and we're looking at the 200 moving average, that's basically summing up the, depending on what you choose. If you chose close as the source of your moving average, so it's going to sum up the closing prices of the last 200 candles and then divide it by 200, all right, to get the 200 moving average, all right, on a rough. Of course, you have different type of moving averages, but that's the rough way that moving averages are created. So what mean reversion suggests is that eventually price will always come back to its average. So that is just the whole concept behind, or that is the idea behind mean reversion, that price will eventually, we don't know when, but price will eventually come back to its moving average. And if you look at your charts, majority of the time, it looks true that when price moves away, far away from the moving average, it has a way of always coming back to it. Either it comes back to it or the moving average, slows down a little bit until price eventually comes to catch up with it. All right. So that's the whole concept behind the mean reversion. So people who trade mean reversion, those are the people who have things like overbought, oversold, oscillators, use RSI, and all that. So we might do something like this. Let me quickly add an RSI to this chart. Oscillators. All right, so let's use 14. All right, so people who trade mean reversion will do something like this. All right, so this is the 200 moving average. Price has traded below it, and our RSI is very oversold. They'll be looking for opportunities to do what? To go up. So because price has really moved away from its average, we are looking for opportunities to go up. Once price moves far above the average, all right, so they might have something they use to determine how far away price needs to move away from this average in order for them to step in and then look at the oscillator and say, okay, price has been overextended to the upside, it's time to come down. Now, every system has its own advantages and disadvantages, obviously. So when you are trading mean reversion, one of the problems you have is the issue of time, like when exactly should I enter? Because price, as we can see here, price can remain oversold for a long time. Like what has been going on in the last couple of days, price was oversold here, it still went down, still oversold, still crawling down and all that. So there is the issue of timing exactly when to get in when you are trading mean reversion, because oversold can still be even more oversold. Overbought can stay even more overbought. So people now begin to try to manipulate the RSI. Some people say, okay, let's go with the 20-day RSI. You will still find out that you will still have periods where you have strong overbought, oversold regions and all that, and it just continues on and on. So that's that about mean reversion. Now, when you are trading, the third type is breakout strategy. Third type of strategy is the breakout strategy. Now, a breakout strategy, basically, we have, so let me go to a smaller time frame. Or I can even stay here. can stay here and still explain what I need to explain. All right. So a breakout strategy can be as simple as price has been making lower highs, lower lows, lower highs, lower lows. All right. So if you look from here, have lower highs, lower lows, lower highs, lower lows, lower highs, lower lows. All right. And then price then does what? Breaks this region. Breakout simply means once this previous high price broke out of it here, we wait for a retest and what? Write it up. It can be as simple as that. Another type of breakout is price has been in a range. All right, so like we see here, price was virtually within this zone. We go to, maybe go to the daily, comes a bit more apparent. Sorry, let me hide this. All right, can see it more clearly now. Good. So if you look at the price, this EG chart, price has largely been, since this is July, price has largely been playing between this zone and this bottom here. All right, that's basically that. So in fact, from like April, right, EG has largely been in this zone here. Let me draw it out for those of us who. So EG was largely in this zone. All right. So to just go hit the top part, drop the top part, come to this bottom, bounce again, and all that. So based on the breakouts, once this box price closed beneath it, some people might say they want to wait for 2 candles or 3 candles to close below it. It means price has broken out to the downside. So they will basically sell. They sell limit here and expect price to continue going down and all that. This is on the daily time frame. You can do this even on a smaller time frame and all that. Again, the problem with the advantage of doing this is that you can catch some really powerful moves. So when you have breakouts, you tend to have very powerful moves that follow later. Now, the disadvantage of breakout strategies is that one, you can have false breakouts. All right, you have false breakouts. And then 2, you might be buying at if you are trying to sell, you might be selling at an already discounted price. All right, price is already quite low, and you are just really hoping it really goes lower. 2, you might have 3, you might have to endure a whole lot of drawdown. So like we saw here, EG still went down after breaking this range, but it pushed up like this first. All right, before continuing down, pushed up again before continuing down. Good, it went down quite all right, but you would have had to endure all this drawdown. So that is one of the issues you have with trading breakouts. Now, the last one is counter trend. Counter trend is really basically going against whatever thing the market has been doing. Now, there's a particular strategy I taught, which has to do with trading weekly OBs. And so what we basically did was to put a 7-period RSI. All right. And then we look for engulfings that happened when price was oversold. All right. So something like this. Let's look at the quick ones we can see on our charts. You can see this. So RSI was oversold here. This is a block here, paying attention to. All right. So once price closed below this is a block you're interested in. This is another place you're interested in. So we expect price to come back here and give a sharp rejection. All right, same thing with this. So the trend has been generally up. All right, price is going up. This weekly So you can imagine that price is going up, price is going up. But we expect that once price comes into this block, we are going to have a major reaction down. All right. Now we have this one here as well. And we're expecting, so price starts coming down, coming down, coming down, coming down, coming down. But we're in this block and we're going to be expecting that at some point we should have a reaction to the upside. So that is, I'm just giving an example. There are so many other ways that you can look at. That. We can come to H4 and trade our HPLR trades, which is basically price is going up, or it has taken out the previous week's highs. Probably the way I like to trade this has done the weekly range. So if EG has a weekly range of, say, on average about 100 and something pips, let's say maybe 120 pips. So it has taken our previous week's high, and we have done from low to high, we have done 170 pips or so. It means that we can have a correction down. So I can choose to trade, maybe go to the lower time frame, look for an entry to take that trade lower. So that is one concept in counter trend trading. Again, one of the issues you have countering the trend is that, just like you have here, price can just keep going down, like, I'm not even looking at anybody's face, it's just going down, right? So it's going down, 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 down. And there is really nothing that anyone can do about that. All right. So, like I mentioned, we are going to be focusing on trend. We want to focus on the trend. We want to focus on trading in line with the trend. So I'm not going to be spending time with all these other ones. So now when you are trading the trend also has its own advantages and disadvantages. Now when trading with trend, it's the path of least resistance. So you usually tend to have more accurate trades. You will tend to have more accurate trades when trading in line with the trend. Two, you will tend to ride massive trends, especially if you can get in early. You can ride massive trends because trends tend to last for a while. So you can ride massive trends. Now, the disadvantage is that if you are caught in a ranging market or when the trend is about changing, you can have a whole lot of false moves. All right. So, but that's still for the average trader. That is still your best bet if you want to profit from the market. So, how do you create a trend following strategy? How do you create a trend following strategy? We are doing basics. Number one, identify your trend. Everybody says the trend is your friend, but identifying the trend is one of the biggest problems of the average trader. Should I buy or should I sell? That is the one question that every trader, the moment you open your charts, you are being asked, or you're asking yourself, should I be buying or should I be selling? Now, I'm just going to give us a few suggestions. Like this night, we are not looking at strategies. I'm giving you how to build a strategy. I'm not teaching you a strategy. All right. So it's a bit different from what we've been doing all the while. So how do you identify your trend? A couple of options. Number one, very easy. We can do what we have here. So you have one moving average. For me, you can use 200 moving average. There are some moving averages that are powerful. I say they are powerful because it has been universally adopted. Let me just put it that way. Let me just use that term. They've been universally adopted. Universally adopted in the sense that a lot of traders pay attention to them. So because a lot of traders pay attention to them, they end up becoming a self-fulfilling prophecy, sort of. All right. So you have the 200 moving average, the 50 moving average, and the 20 moving average. So these are the two moving averages that are most often used by traders in identifying the trend. So you're often told the 20 moving average tells you the short-term trend, the 50 moving average tells you the medium-term trend, and the 200 moving average tells you the long-term trend. So if you trade stocks, once the stock index is below the 200 moving average for about 2 days, 3 days, we are said to be in a bear market, all right? And if it's above the 200 moving average, we say we are still in a bull market and all that. So we can apply the same principle even when it comes to forex trading. So as you can see on my screen, this is the 200 moving average. It's as simple as saying if price is above the 200 moving average, I'm basically looking to buy. And if price is below the 200 moving average, I'm basically looking to sell. All right. So it can be as simple as that. So price above the 200 moving average, I'm looking to sell. Price above, I'm looking to buy. Price below the 200 moving average, I'm looking to sell. Why is this so? I'll try to do my normal Prof work. So I always like to give explanations for why, or the mathematical explanations for why things are the way they are. All right. So your moving average is an average. All right. Even though it's called a moving average, it's still an average. Now, if the average, if price is below the average of the last 200 days, it means that the momentum is to the downside. Right? It means that when I sum up what has happened in the last 200 days, where we are now is still below that average. If we are below the average, it means that currently sellers are in control. Basically, the bears are in control. We are bearish. If I look at price at the moment and consider it with respect to what price has been doing in the last 200 days or last 200 candles, as the case may be, it basically means we are in an uptrend. Prices above that, all right, because it means we are still pushing. We are pushing higher. We are going higher compared to what has been happening in time past. So that is one way we can do that. Another simple way we can do is to go the BTMM way, where we use multiple moving averages. We are still coming back to naked charts. So just allow me. All right. So let's put the 50 moving average. Right. Just a moment. All right. Okay. So explaining, you can use moving averages. You can have two. People usually say that it's best to have 3 moving averages. So let's just use a third one. Let's do the BTMM way. We use the 30 moving average. Obviously, have 800, 250, 13. Let's just put our 30 moving average and call that a wrap. Let's don't need making it that more complex. Or we can just even use our 20 moving average. Let's use our 20 moving average. So that we stay with the popular moving averages. All right. So how do we do this? So once we have, for those of you who have been following SimplyPips for a while, this is very, very simple. Once you have all moving averages stacked like this, so you have your 13, your 50, your 200, all lined up like that, all right, in ascending order. So once you have your moving averages arranged in ascending order, all right, 13, 50, 200, we are looking for opportunities towards to buy. Like at this point, to be looking for opportunities to buy. We are looking for opportunities to buy. We'll still be looking for opportunities to buy. And then this crosses below and we are no longer looking for anything. So at this point, we don't have any business with charts until everything strengthens out again to the downside. So you now have the reverse. We are now in descending order. So 250, all right, and then your 20 moving average. So at this point, we are looking for opportunities to sell. We are looking for opportunities to sell. We'll just be looking for opportunities to sell. So that's one way of identifying your trend. So in creating any trend following strategy, you need ways to identify your trend. Let's quickly look at another one that I like using. So another one is to use the Hikinashi. All right, since we have already been dealing with EG, let's continue dealing with EG. All right. So how we do this is very simple. If the last, for instance, we are looking to know whether you want to take a weekly trade, a weekly swing trade, which is basically what I do. I trade swings. So what you'll be looking at is once the previous Hikinashi is bearish, as red, you are looking for opportunity following week to sell. Previous week is red, we are looking for opportunity to sell. Previous week is red, we are looking for opportunity to sell. Previous week is red, you are looking for opportunity to sell. Now, where you run into trouble is places like this where there's a lot of ranging going on, like I mentioned earlier. That's where you run into trouble with kind of with trend following strategies. But even at that, see this. You have all this. You have this. You have all this. This will make you might just have trades that will just go, maybe give you TP1, come back to break even, hit you out, give you 1 hour, come back, hit a sell, and all that. But eventually, you have all these major runs. You still have 1 week of buy. This tells you sell. You would have lost because here you'll be trying to buy initially. Then this week, you get your money back. Then this week, you lose part of that money. This week, you get it back. So basically, when you're in a range like this, you'll just be doing give and take with the market. So, but eventually the trend will eventually develop and you make back. So all the body that you are doing give and take here, eventually you make your money here. 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 All right. A bit of money is made here. A bit of money is made there. So when you open any chart, you can just see this is GU. All right. So you can see that it is usually best to just relax your mind and trade in line with the trend. So your Hikinashi is one way of doing it. Let's look at the final way, or one of the ways. Let me see final way. So we've talked about the institutional order flow. All right. So what I'm explaining now are for people like us, people like me. I'm not saying people like us, people like me that are lazy traders. You know, people like me that are lazy traders that we don't have strength to come and be marking up too many things. So I've given us 3 methods now where we use 1 moving average, and I've told you you can use a very very short term moving average like 20 moving average, just put it on a higher time frame like a weekly or the daily, and use it to get your bias, or use something like 200 on something like H4 or H1, which was what we used when we were talking about slingshots. I remember we discussed it early last year. I mentioned using multiple moving averages. I've mentioned using the Hikinashi. So the last one we are going to do is we're not putting anything on this chart. I want to just look at the pure naked charts. All right. For those of you who like trading naked charts, we're looking at EG. So let's stay consistent with EG. All right. Now, how do we trade this? What we are going to do is simple. We are going to be looking for, this is on the weekly. So you know how big that is. So we are going to be looking for weeks where we have higher highs and higher lows. Remember what we said about when we are looking to buy or sell. What are we looking for? We are in an uptrend where price is creating higher highs and higher lows. So we're in an uptrend where price is creating higher highs and higher lows. So what we can simply do is that we can come to this place instead of looking for when structure was broken, like say on H4, we are looking for when structure was broken and all that. We'll just simply look at the highs and the lows. All right, so we'll do something like this. Let's put a line. This is our trend. So let's start from somewhere here, just for ease. So this is Okay. See the disadvantage of MT4. All right, you just follow my distance so that we don't waste our time. So this is the high of this week. This is the low. The following week we get a higher low and a higher high. All right. So once we come to our charts and look at the 2 previous weeks, and we see that we have what higher highs, higher lows, we take it that we are in a what we are in an uptrend. So this following week we'll be looking for what opportunities to buy. So obviously, even though it means that this went from up here, the fact that price reached this point means that it went up and then probably now came down later. All right, but first did what sharp pushed up. So if we are looking for opportunities to buy, we would have seen that and it pushed up. So the following week would have been looking for opportunities to buy. All right, instead the trend changes and comes down. So we might have had a loss here. We got an entry. So for now, what we are looking for is buyers. Forget, we are not talking about how to look for entries. Just let's focus first. We are looking for buyers. Should we be buying or should we be selling? So we come this following week, lower highs, lower lows. So we should be looking for opportunities to sell. So we sell. All right. So we made money here. We lost money here. We made that money back here. All right. So here again, would have been looking for opportunities to sell. Why? Lower highs, lower lows. So we sell. So whether we lost or made money here is a bit uncertain. Price could have pushed down first, or price could have just pushed up, started from down, because obviously it's a gap. So we don't know. But let's assume we lost money. All right. So we have one win, one loss, one win, one loss. So again, based on this, we still have lower highs and lower lows. So this week we'll be looking for opportunities to sell. Again, price pushes down here. So we make money. We are 3-2, right, in our favor. And then this week would have been looking, this week is indeterminate. Why? Price was neither gave us higher highs and higher lows or lower highs, lower lows. So this was basically a ranging. So this week we will not have a bias. So we'll leave EG for this week. And then by the time we come to this week, we would have seen higher high, higher low. We're looking for opportunities to buy. We would have lost money here. This week, we're not trying to touch anything. All right, we won't be trying to do anything here. And this following week, we'll be looking for opportunities to sell. We might have made some money with this push to the downside here before coming to hit our stop loss. But let's assume we lost. All right, so we're on 3-3 now. Now we have higher highs, higher lows, and price pushes up. So we'll have made money before it still came down. All right, and we'll just do that on and on. So we'll have been selling. So like we saw before, this was a ranging period. So a ranging period is where you are doing basically what buying and you are just exchanging with the market. Makes more money, this more money, makes more money, this more money. For those who are in the first stream program, I've explained to you, I mentioned to you guys the periods where we tend to have this a lot. All right, I mentioned to them when we tend to have a lot of these ranges and when trends tend to develop. So it's something that is not strange. It's something I'm not going to mention it. It's something you can go into your charts and look up. There are periods of the year where we tend to have more ranges, and periods of the year where we tend to have more trends than ranging market across different currency pairs. So you can go into that research. So here again, we have been looking for opportunities to sell, sold, sell, sold, sell, sold. So all that money that we were just doing 3-3, once it just came into this period, we just got a couple of very good trades, 1, 2, 3, and even this week 4, and that would have covered for all these things that was going on here. So I've mentioned a couple of ways that we could do this. We've looked at about 4 And of course, when you add it to the IOF, you are looking at about 5 different ways to identify your trend. So once we are sure that we've identified our trend, the next thing, we don't just want to jump in. We want to look for good opportunities. So the next thing that we'll look at is the next popular axiom. So the first one that we've looked at, the popular axiom we've looked at, that is always mentioned to new traders. If the trend is your friend, right? But the question is, how do you identify the trend? So the second thing that you always told is buy low, sell high. And of course, some people tell you buy the deep, and you buy deep until the deep becomes deeper and deeper becomes deepest. So how do we know when to enter? How do we know where is high? How do we know where is low? So and that is what brings about the concept of discount and premium. So discounts, when we are looking to buy, we are looking to buy at a discount. So if we are in an uptrend, if we have identified our trend to be a bullish trend, we have decided to be an uptrend, all right, we are looking to buy. So we'll look to buy at a discount. If we are looking to sell because we've identified that we are in a downtrend or in a bearish market, we'll be looking to sell at a premium, all right, when it is expensive. So premium high. So we are looking to buy at a discount. We are looking to sell at a premium. Again, I'll mention a couple of ways that you can do this. So let's go to our moving averages. And what we are going to do real quick is we are going to use our 20 moving average. We are going to use our 20 moving average. So once price goes above the 20 moving average, remember what we said, that the 20 moving average gives you the direction of what? The short-term trend. So once we discover that this overall trend is still bearish, once the very short-term trend turns to bullish, meaning it has become oversold. So we don't even need, we can discover overbought and oversold regions without even using our oscillators. In fact, this evening, let me not even use the oscillator. Let's use different other ways that are not oscillators. I will explain to you 2 other ways that you can view overbought and oversold without even looking at any oscillator. So one has to do with moving average, one is naked chart. So for those of you who like naked charts, but that's the, let me see. I'm going to do something right now. I have 38 people on this call. All right. So this thing I'm going to share, I'm going to pause the recording. Any person that is not here is not going to hear it. Just remembered something. Let's just leave it like that. Let's see the bonus that we give out. All right. Okay. So the 20 moving average is telling us the really short-term trend. So once price goes above that short-term, that 20 moving average, we look for opportunities to sell. So we look for opportunities to sell. We'll be looking for opportunities to sell. We are looking for opportunities to sell. We are looking for opportunities to sell. Again, here, once price has come below this 20 moving average, we are looking for opportunities to buy. Once price has come below this, we are looking for opportunities to buy. Once price has come below this, we are looking for opportunities to buy, like that. And then I'm going to include some other rules that we can look at that maybe we want to filter it further and all that. But let's look at the other way to identify overbought, oversold without having anything on your chart. All right. So virtually the entirety of December, if we go to our H4, okay, at least from this week, from the, what's this? From the 24th of December, at least we were in a downtrend from the 24th of December. So let me show you how You can look at overbought, oversold. So 24th, 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 24th. All right, so this is 24th. Now, how do we identify overbought, oversold redrafts? So we see this price is coming down, right? Now, once you have a bullish bar like this, remember we're supposed to be in a downtrend. All right. Once you have a bullish bar like this, you will just be waiting for a second push up. Those of us who are familiar with some other concepts in trading would identify where maybe this was adapted from. All right. So you look for a second push up and then you're coming down. So that didn't happen here, sadly. Price continued down. So here, all right, we have a bullish candle. Once price pushes above the high of that bullish candle, we are overbought. Naked charts, pure naked charts, no indicators. All right. Again, we are, let's look at this. What's the high? 83722. This is 83722 as well. All right. Still the same thing. We have a bullish candle. Once price taps that high or goes above it, you're overbought. You're looking for opportunities to sell. It's that simple. If you are in a downtrend, so if we used let's just keep it at that. So e.g., let's look at, if we use Higinashi, virtually the whole of December. So from 19th, a week of the 19th, we've actually been overbought. So have a bullish candle. Once price did not do that, and it moved on. I'm looking for one that has a good example. I think we had a good example on GU. All right, yeah, good one on GU that happened recently. So we're in an uptrend. Once price, where was that? Okay, yeah. Okay, so for those of you who trade IOF, this was the last bullish candle responsible for this push to the downside, right? So once price broke above this, would have seen this as a bullish trend. So I'm just giving you guys, using different methods of looking at our buyers. So you see still the same thing. So now we are in an uptrend. So how do we know we are oversold? Simple. Bearish candle. Now we are looking to go up, right? Bearish candle. Once the low of that bearish candle is taken, we are looking for opportunities to buy. Again, here, bearish candle. Once the low of that bearish candle is taken, we are oversold, we are looking for opportunities to go up. It's really that simple. All right. So no indicators, no guesswork. Just come, it's simple. Just look at your candles. We are in an uptrend, we are looking for bearish candles. Bearish candle, once the low of that bearish candle is taken, we are looking for opportunities to go up. Simple. All right. So I've mentioned two ways we can look at our discount and premium. Mentioned using a short-term what's it called, moving average, such as the 20 EMA, or naked charts. You are looking for, in an uptrend, you are looking for a bearish candle whose low has been taken. All right, bearish candle whose low has been taken, that is oversold. So we've had two pushes to the downside. That's just the basic meaning of that. Right, so we have two low, a lower low. So once we've had that lower low formation, we are looking for opportunities to take it up further. All right. So what we are doing here is simply saying that market makers will try to induce sellers. Okay, let me not go into that yet, because that's the next thing we are coming into. So apart from your discount and premium, there are some other things we discussed, such as liquidity runs, false moves, liquidity runs, and all those things that try to either induce sellers into taking positions that are contrary to where they intend to move to, in order to find sponsorship, as we tend to call it. In fact, I don't want to use big words. So they are basically trying to get sellers to face the wrong way. All right. So we are trying to buy. In the case of um, GU that we have here, we are trying to buy, but they basically tell sellers, they make sellers feel we are now selling. So people coming here to sell and they just basically take all their money away. All right. And then the other concept that you can try to, I'm just mentioning different things you can put in now to act as filters. So we've located our trend. We've identified overbought, oversold, we've identified what we call discount and premium. So once you identify your discount and premium, you are looking at, next thing you are looking at is other things that you can use as filters. I'm now mentioning the fact that you can use liquidity runs, you can use false moves as extra confirmations or extra filters. So if you are using this method of saying a bearish candle whose low has been taken, automatically we've already factored in liquidity runs because previous daily lows has been taken, right? So those who are on a short-term time frame would have been, they would have had, remember this was looking like an uptrend before. So some people would have entered this market on this, around these lows. Some people would have entered around some lows here. So by simply raiding all those lows there, they have taken some, they have run out some stops. All right. And of course, you can now use the concept of false moves, which is also already inbuilt into what I talked about initially. If you are using this method, or even if you are using the method of the moving averages. So the 20 EMA, is giving you the short-term time direction for your short-term buyers. So those who are trading just that short-term, who are just looking at that very, very short-term picture and not looking at the macro picture, will have been induced to sell. All right. So if we come here and put, let's put GU. Let's put on GU. So let's use something like, okay, let's even use here. This is the 16th of December, 16th to about 21st of December. All right. So even on this time frame, on just H4, if you are using your moving averages, you would have still be having a sell bias. All right. You will still be having a sell bias for a while around here. All right. So you might have been part of those that were induced, but let's even go to one that was clear to everybody, or that would have been clear to everybody, which is right here, 28th, 29th, 28th, 29th. For me, December is not. Once we've entered the third week of December, any smart trader should be off the market. But let's look at it. 28th. What was that? 29th of December. All right, so right here. So again, you see that price broke through the 20 moving average. So at this point, we're in an uptrend. All right, we just crossed into an uptrend. Right. So we would have been waiting for price. Would have been waiting for a false move. A false move would have been price closing below the 20 moving average. So those who trade breakouts would have seen this as an inclination to go short. All right, begin to go down. But we would have been seeing this as an opportunity to go up. All right, if we go further, maybe going to November, it becomes a little bit clearer because December is not actually the first time. So the actual wise trader should have stopped trading somewhere here. Should have been your final trading at least until maybe this week, or in fact until this current week that we are in. Should have been on holiday as well. All right, so let's just look at what happened this period. Starting here, and then see how that works. So earlier in December rather, have this bullish candle, price runs it out just a little bit, and then we are looking for opportunities to run. If your SL was too tight, sorry, so that beat you out, or else you are fine. Again, we're waiting. We are waiting for a bullish candle. So we have this bullish candle. Once price takes out that high, we are looking for opportunities to sell. Then we wait again, bullish candle. Price takes out that high. Whether it fell from here, I don't know. It have just gone up straight. So if we are still bearish, so if we are using that H4 method, all right, we are using the H4 method, you would have seen that on that 16th, where we were still bearish before this thing eventually crossed. Because this cross, even though it's looking to you like, okay, no, at that point this has crossed. So we are now bullish. When we're looking for this again, so we would have been looking for opportunities to sell here, which would have gotten opportunities to sell here, which we would have gotten, no matter how small that move may look like. So these are, so I've mentioned looking for your trend, I've mentioned discount and premium, I've mentioned other trading concepts that you can include, such as false breaks, liquidity runs. Then the final thing that's, or second to the last thing that you'll be looking at in creating any strategy is your entry trigger. So yes, it's good to have found my trend. I'm in an uptrend. I've discovered that okay, I'm now at a discount level. Price has pushed down. So maybe liquidity has been run out in form of yesterday's lows or yesterday's high, depending on where I'm looking to go. So we're looking to go up. Yesterday's lows has been taken out. What then will I see that will make me to place a trade? So as I explained to them in the fostering program, there's a difference between a trade setup and actual entry. So a setup begins to present itself the moment I see this. So 1, 2, 3 presents a trade setup, or what I call a potential trade. All right. But until I see an entry trigger, I don't get it. So entry triggers that you can use, again, I'm going to explain different styles for different people. So I want to believe we are all of different mix. So the first one is pure price action. All right. So again, we'll come here. So what you can do is, which day did we have that move? So this was on the 29th. We can come to say 30 minutes. We can come to 30 minutes on the 29th. 29th of December 2021. Uh-oh. All right, and we are looking for opportunities to buy. So let me zoom this in a little bit so that you can see what we are looking at. Remember what we said? Wanted to see a bullish day and then the low of that bullish day taken, so which we had on the 29th of December. So once price takes out this low, we start looking for opportunities to buy. What can be our entry trigger? Number one entry trigger, price action. So what we'll simply do is I will mark up the bearish candles as they go. This is my preferred method of entry, which is virtually what we use in the fostering program. At least majority of us use, I'll say all. All right. So we'll mark up the bearish candles, the lowest bearish candle that was created. The moment price closes above that candle, that is your trigger. So you set your limits at the tip of this bearish candle. Price comes back, retests, and up you go. Right? So you would have seen how powerfully moved that was. Here you had about to the peak, you had about 127 pips. If you did not run away too early, you could have gotten as much as 178 pips. In fact, it's still going up if I'm not mistaken. So depending on your risk appetite and how much you can hold trades. So that is one entry trigger where we simply use naked charts and we use price action to tell us when we should head into this trade. Right. All right. So the next method that we can use is to use moving averages. So let me quickly add one here, moving average. Let me add something like the 13 moving average. All right, so we could say that once price closes above the 13 moving average, we are looking for opportunities to buy. That's also another one. All right, so once price closes above the 13 moving average on a lower time frame, we are looking to buy. So we are 30 minutes. For me, I found 30 minutes to be like it doesn't give us as many false breaks. Like if you're trading on 15 minutes, you should be ready for a whole lot of playing with your emotions. In this case, this would have actually given us probably an earlier entry. So either you use this or use this or use this, depending on the way you want to frame that, but all closed above this, and then you enter either on a retest or you enter straight away, right? And you take this up. So if you look at those are two ways that we can do this. Of course, you can add different other entry triggers, like say you have I don't like complicating matters, but some people trade like that. So one of the things you can do, let's remove this. Okay, something else you can do, and then move on. So this is where we are. So we can come right here and use our Fibonacci tool. All right. So what I usually do is the last. So this is the bearish candle here. This is not a method I use. I saw it somewhere. Reading about it, so it's something you can look at. So the last bearish candle that was here, not this one that was created. Oh, okay, don't worry. I'll just reset this. Okay, so I need to expand that so that we can see it. Oh, can't do more than this for now. All right. So the whole concept here is I think I still missed it. I didn't do this properly. Okay, no, I did. All right. So the whole concept here is this: not this bearish candle, not the one you are working with. You go and mark up the last bearish candle before this one you're working with. So this is the candle that we use to, okay, we've had a bearish candle, the low is taken, and then we are going up. So you are not looking at this. Once you see this candle form, you go and look for the last bearish candle, right, before that one, and you mark it up week to week. So price comes back to the 61.8, and that becomes your own entry to go up. This is not my recommended way of trading, but it's something that you can do, something you can look at doing if you must. But I just prefer either use the moving average or use price action. So the last thing that you need to take into consideration is your risk management. Where will your SL be? Where will your TP be? And then what percentage of your account should you be risking per trade? As we begin to wrap this up. So what's SL? Where should your SL be? So if we are going to be using that pure price action method that I explained earlier, so for those that are in the fostering class, you know how I like to set my own SL. You know what I always add. So I always make room for hunts, for widening of spread, and every other thing that can go wrong a little bit. So give it a bit of breathing room. The fostering program, we have a technique we use. We're going to be talking about that here. So just give, you can decide to, this is from top to bottom here, you have about 10 pips. So I can decide to add maybe 2 extra pips to be 12 pips or something. Or even add up to 3 pips to make it 13 pips. All right, so my SL will be 3 pips lower than the low of the peak. All right, so I'll just put my SL 3 pips lower than the lows of all these candles here. So that can be your whole rule. All right, then you can do a rule that my TP, you can use there are different ways you can set TP. You can decide that my first TP will be the previous day's high. If you do that, your TP1 would have been about 3R. All right, you can decide that previous day's high will be my own TP. You can decide that I want to use ratios. I want to use R's. So 1R, 2R, 3R. So I can decide to go for 1R. I can decide to go for 3R, which will be 39 pips. I can start going for 5R, which will be about 65. Did we get that? Yes, we got that same day. I've gotten 65 pips, which would have been 5R. All right. So how you do that is really up to you. Now, risk per trade, that again is up to you. Recommended, never use more than 3% of your account if you are trading your own account. Obviously, for those of you that are in the fostering program, you are trading a proper account. You dare not, you dare not even use 3%, except you are maybe doing asymmetrical compounding or something like that. Else, you could quickly find yourself in back in your village. So, but recommended you should be using about 1% of your account to be conservative. And if you are trading for Prof, depending on how many pairs you are trading and all that, it could even be as low as 0.75 or 0.5% per trade. All right. So I'll take 3 questions because our time is already far gone. I'll take 3 questions and we'll call it a wrap. I'll take 3 questions, only 3 questions, the first 3 questions, and we'll call it a wrap. If you've gotten something from today's class, please put 111 in the chat box. If you got something from today's class, put 111 in the chat box. All these fostering people that are here. What else people want to learn? George, Leo, what else do you people want to learn? King Zombie, what else do you want to learn? got Patrick. Hey, doctor, you're also here. It's all right. All right. So, any question, and then we can call it a wrap. There are no questions. We can quickly wrap this up. All right. So, please, we should not be begging. We should not be begging you guys for this. We should not be begging you guys for this, but it seems people always like us to be begging that okay, go and like the YouTube page and all that. We have over how many thousand members on Telegram, yet the YouTube this thing is just 200 and something likes. Good enough that we have just started a new channel and all that. But Abba, this is a new year. People should repent. All those things people were doing last year on the whole channel, people should repent this year. All right, let's enjoy the rest of our week. Please be careful if you are still trading now. The markets are still